before 2026, estate tax changes affecting 12 million plus estates. If you're over 60 and have built an estate worth $12 million or more, there's a looming financial storm you cannot ignore. In less than 2 years, federal estate tax exemptions are set to drop by nearly half, potentially exposing millions of your hard-earned dollars to new taxes. Let me repeat that. What you leave behind could be taxed at rates up to 40% unless you act before 2026. For affluent retirees, this is a critical, often overlooked threat that could devastate your legacy and your family's inheritance. The longer you wait, the fewer options you'll have, and every month of delay could cost your heirs hundreds of thousands. In my 3 decades of guiding high-net-worth families through complex transitions, I've seen too many lose generational wealth simply because they weren't prepared for changes like these. After analyzing thousands of estate plans, I can tell you, the most successful retirees always act before the deadline, not after. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation. Past performance doesn't guarantee future results. Today, I'll reveal the top strategies affluent retirees are using right now to protect their estates and minimize taxes before the 2026 law changes hit. By the end of this video, you'll know exactly what steps to consider to secure your legacy and give your family the maximum benefit. What I'm about to share could save your heirs millions, so pay close attention because missing this window could change everything. Part 1. The looming estate tax threat, why 12 million may not be enough. If you're a retiree with a substantial estate, let's say $12 million, $15 million, or even more, you've probably spent decades working, saving, investing, and making thoughtful decisions to build and preserve your wealth. You've done everything right to create a legacy for your loved ones. But let me share something that may surprise you. The rules protecting your estate from federal taxes are about to change dramatically, and the clock is ticking. Right now, in 2025, the federal estate tax exemption stands at $13.99 million per individual, or $27.98 million for a married couple. That means if your estate falls below those numbers, you can pass it on to your heirs without paying a penny in federal estate taxes. But here's the reality check that most people, even many experienced financial advisors, aren't talking about. On January 1st, 2026, unless Congress acts, the exemption will drop to approximately $7.0 million to $7.25 million per person, or $14.0 million to $14.5 million for a couple, adjusting for inflation. That's a reduction of nearly 50%. Let me repeat that. In less than 2 years, you could lose more than half of your estate tax protection. Now, why does this matter so much for retirees like you? Because if your estate exceeds those new limits, even by $1, everything above the exemption will be taxed at a federal rate of up to 40%. Imagine you have an estate of $15 million as a single filer. Under current law, you'd owe nothing. But in 2026, with the exemption dropping to around $7.0 million to $7.25 million, nearly $8.2 million of your estate could be subject to federal estate tax. That's a potential tax bill of over $3.2 million. For couples, the numbers are even more staggering. If your joint estate is $20 million, you could be facing a tax bill of over $2.5 million that your heirs never saw coming. And that's just the federal level. Many states, including New York, Massachusetts, and Oregon, have their own estate or inheritance taxes, some starting as low as $1 million. In some cases, families are hit with a double tax, federal and state, compounding the loss. Over my 30-plus years working with affluent retirees, I've seen families forced to sell cherished properties, family businesses, or even valuable heirlooms just to cover an unexpected tax bill. The most heartbreaking part? In many cases, this could have been prevented with proactive planning. Let's pause and look at the bigger picture. According to the Tax Policy Center, the number of estates subject to federal estate tax is projected to more than quadruple after 2026. In 2021, only about 0.2% of estates owed federal estate tax. By 2026, that number could rise to nearly 1%. But among high net worth families, the impact is far greater. If you're in that top tier, your risk jumps exponentially. And the IRS collected $27 billion in estate taxes last year alone, a number set to soar once the exemption shrinks. Now you might be thinking, my advisors have told me I'm safe. But here's what most don't tell you. Estate values can change overnight. The value of your home, your investment portfolio, even life insurance payouts all count toward your taxable estate. And inflation is pushing asset values higher, meaning more families will cross the new threshold without even realizing it. If you own real estate in high-value markets like California, Florida, or New York, or if you have substantial retirement accounts, you're at even greater risk. Here's another sobering statistic. A recent survey by U.S. Trust found that 56% of wealthy retirees have not updated their estate plans in the last 5 years. And 41% of those with estates over $10 million have not considered the impact of changing tax laws at all. That means nearly half of high net worth Americans are heading into this deadline unprepared. Every month you delay planning could cost your family tens or even hundreds of thousands of dollars. Let me share a story from my own experience. A client, let's call him Mr. H, had a $14 million estate, mostly in real estate and retirement accounts. He assumed the current exemption would always protect his family. When we reviewed his plan, we discovered that if he didn't act before 2026, his heirs would face a $2.8 million federal tax bill, plus another $900,000 in state taxes. By making a few timely moves, transferring assets, setting up trusts, and using charitable gifting, he was able to reduce that tax bill by over 70%. But if he had waited just a year longer, those strategies would have been out of reach. This is educational content, not personalized financial advice. You should always consult with a qualified financial advisor for your specific situation. Laws and exemptions can change, and every family's circumstances are unique. What I'm sharing is based on decades of experience and current law as of 2025. So, why is this so urgent for retirees over 60? Because the window for action is closing fast. Some of the most effective estate planning strategies, like making large gifts, funding irrevocable trusts, or shifting assets out of your estate, take time to implement. The IRS has specific rules about clawbacks and gift timing, and some moves must be completed months before the deadline to be effective. If you wait until the last minute, you may find that your options are limited, or worse, that you've missed the opportunity entirely. And let's be honest, navigating estate taxes is complicated even for experienced investors. The rules are constantly changing, and the stakes are higher than ever. The most successful retirees I work with always stay ahead of the curve, reviewing their plans every year and adjusting for new laws. Industry insiders know that proactive planning can mean the difference between leaving a lasting legacy and losing millions to taxes. Let me be clear. This isn't about beating the system or finding loopholes. It's about using proven legal strategies to protect what you've worked so hard to build. In my 3 decades of helping retirees, I've seen too many families blindsided by tax changes they never saw coming. The sooner you address this, the more options you'll have, and the more you can leave to the people and causes you care about most. So far, we've covered the looming threat of estate tax changes, the shocking statistics behind the coming wave of taxable estates, and why this matters more than ever for retirees with substantial assets. You now understand the urgency and the potential cost of inaction, but here's what most financial advisors won't tell you. There are strategies available right now, if you know where to look and act before the deadline. The solution is simpler than you think, but most people get it wrong. In the next section, I'll reveal the core foundation of estate tax planning for high net worth retirees and show you exactly why it works, especially for those over 60. Stay with me, because this could be the turning point that secures your legacy for generations to come. Part 2. The core foundation. How strategic gifting and trusts can shield your legacy. Now that you understand the gravity of the coming estate tax changes, let's shift our focus to the solution, a proven conservative approach that has helped thousands of affluent retirees just like you preserve and protect their family's wealth. In my 30-plus years of guiding high net worth seniors through turbulent tax environments, I've learned that the most powerful safety-first strategies are often the ones hiding in plain sight. The foundation of effective estate tax planning, especially before 2026, comes down to two essential tools: strategic lifetime gifting and the intelligent use of irrevocable trusts. Let's start by breaking down why these strategies are so effective, particularly for retirees over 60. The federal estate and gift tax system is unified, which means the exemption, the amount you can transfer tax-free, applies to both lifetime gifts and assets left at death. Right now, you have a rare window of opportunity. You can use today's higher exemption to transfer up to $13.99 million per person, $27.98 million for couples, out of your estate, either through direct gifts or by funding trusts. After 2026, this window slams shut, and the exemption will revert to about $7.0 million to $7.25 million per person. If you act now, you lock in the higher exemption, and the IRS has confirmed that these gifts will not be clawed back even if the exemption drops later. Let me repeat that crucial point. The IRS has explicitly stated that if you make large gifts now, before the exemption drops, you will not be penalized later. This is a once-in-a-generation opportunity, and the most successful retirees I work with are taking full advantage of it. But why does this matter so much for seniors? Because as you approach or enter retirement, your financial picture becomes clearer. You know what you'll need for your lifetime income, health care, and emergencies. That clarity allows you to make thoughtful decisions about what you can afford to give away, without jeopardizing your own security. And by acting now, you're not only protecting your legacy, but also reducing the risk that your heirs will be forced to sell family assets or pay a massive tax bill down the road. Let's look at how this works in practice. Many retirees find that a combination of outright gifts and funding irrevocable trusts provides the flexibility and control they need. Outright gifts are simple. You transfer assets, cash, stocks, or even real estate directly to your heirs or beneficiaries. The value of these gifts is removed from your taxable estate, and if you act before 2026, you can use the higher exemption to shelter millions from future taxes. For example, if you gift $10 million to your children in 2025, that amount is forever excluded from your estate, even if the exemption drops 2 years later. But for many seniors, giving away large sums outright feels risky. You may want to ensure your heirs use the money wisely, or you may want to retain some control or income from the assets. That's where irrevocable trusts come in. By transferring assets into a properly structured trust, such as a spousal lifetime access trust, SLAT, grantor retained annuity trust, GRAT, or an irrevocable life insurance trust, ILIT, you can remove those assets from your taxable estate while still providing benefits for yourself, your spouse, or your chosen beneficiaries. These trusts can be designed to pay income, restrict access until certain ages, or even support future generations. Let me share 2 real-life examples, drawn from my years of experience, though names and details have been changed to protect privacy. First, there's the case of a retired couple, both in their late 60s, with an estate valued at $18 million, including a family vacation home and a large stock portfolio. They were deeply concerned about losing the home to estate taxes and wanted to keep it in the family for generations. Working together, we established an irrevocable trust for the home and made a $10 million gift to their children and grandchildren, using their combined exemption while it was still available. Not only did this remove the home and the gifted assets from their taxable estate, but it also gave them peace of mind, knowing their family would not face a forced sale or a massive tax bill in the future. The second story involves a widowed client in her early 70s with a $13 million estate, much of it in retirement accounts, and a valuable art collection. She was hesitant to part with assets she might need for health care or unexpected expenses. Instead of making outright gifts, we used a grantor-retained annuity trust, GRAT, to transfer appreciation on her investments out of her estate while still providing her with a steady income stream. Over a few years, she successfully moved nearly $4 million in growth out of her estate, tax-free, while retaining the security she wanted. When the exemption drops in 2026, her heirs will face a dramatically smaller tax bill. These are not isolated cases. Industry insiders know that the families who thrive across generations are those who plan ahead and use these time-tested strategies. The key is to act while you still have the higher exemption and before the rules change. Every month you wait, you lose precious time to implement these moves, and the administrative process, setting up trusts, transferring assets, working with your legal and tax advisors, can take several months to complete. Now you might wonder, isn't gifting just for the ultra-wealthy? The answer is no. Even if your estate is just $12 million, the difference between acting now and waiting until after 2026 could be a tax bill of $2 million or more. And remember, the value of your estate can grow quickly, especially if you have appreciated real estate, a thriving business, or a well-managed investment portfolio. Many retirees are surprised to find that with just a few years of growth, their estates cross the new threshold with ease. It's also important to note that these strategies are fully compliant with current law. This is educational content, not personalized financial advice. Always consult with a qualified financial advisor and estate planning attorney for your specific situation. There are no guarantees and laws can change, but historically, those who plan ahead have enjoyed far better outcomes. So far, we've covered the core foundation, using today's high exemption for strategic gifts and irrevocable trusts to reduce your taxable estate. We've seen how these strategies work for real retirees and why acting before 2026 is so critical. But knowing what to do is only the first step. The real power comes from understanding exactly how to implement these moves, step by step, so you can avoid costly mistakes and maximize your results. Now, let me show you exactly how to implement this with the practical steps you need to take, starting today. Before you do anything, though, there are common pitfalls and timing issues you absolutely must avoid. That's where most people get it wrong, and where your opportunity to protect your legacy can be lost in an instant. So, let's move forward and make sure you have the roadmap you need for success. Part 3. Step-by-Step Guide, How to Shield Your Estate. Before the 2026 tax deadline. Building on the core foundation we've just discussed, it's time to get practical. You now understand why acting before 2026 is so crucial and how strategic gifting and irrevocable trusts can protect your legacy. But what exactly should you do step by step to make sure your estate is prepared for the coming changes? In my 30-plus years of working with affluent retirees, I've seen that the difference between preserving millions and losing them to taxes often comes down to following a clear, actionable process, one that leaves no detail to chance. Let's walk through the specific steps you need to take, including the numbers, timeframes, and processes that will help you secure your family's future. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor and estate planning attorney for your unique situation. Laws can change, and every family's needs are different. But these are the proven steps that have helped thousands of seniors just like you. Step 1. Calculate your current net worth and project future growth. The first step is to get a precise, up-to-date picture of your total estate. This means more than just looking at your main checking account or your home's value. Add up everything: primary and vacation homes, investment properties, retirement accounts like 401ks, IRAs, and Roth IRAs, brokerage accounts, life insurance, death benefits, business interests, valuable collections, and any other significant assets. For example, if you have a $4 million primary residence, $3 million in retirement accounts, $2 million in stocks and bonds, $1 million in life insurance, and a $2 million vacation home, your total estate is $12 million. Don't forget to include assets that could appreciate in the next 2 years. If your investments grow by 5% annually, that $12 million could become $13.2 million by 2026. Once you have your number, compare it to the projected 2026 exemption, about $7.0 million to $7.25 million for individuals, $14.0 million to $14.5 million for couples. If your estate is even close to those thresholds, you're at risk. Many retirees underestimate how quickly their estate can grow, especially with rising real estate and stock values. Industry insiders know that failing to account for future appreciation is one of the most common and costly mistakes. Step 2. Meet with your estate planning team and set a firm deadline. Next, schedule a meeting with your estate planning attorney and your financial advisor as soon as possible. I always recommend doing this within the next 30 days. The reason is simple. Setting up advanced strategies like irrevocable trusts or making large gifts can take several months from start to finish. Legal documents need to be drafted and reviewed. Asset valuations must be completed, and in some cases, appraisals or business valuations are required. If you wait until late 2025, you may run out of time and lose your ability to use the higher exemption. In my experience, the most successful retirees set a firm deadline for themselves and their advisors. For example, we will have our gifting and trust strategies in place by June 30th, 2025. This gives your team enough time to address any unexpected issues and ensures you're not scrambling at the last minute. Step 3. Decide how much you can afford to gift or transfer without jeopardizing your lifestyle. This is where a conservative, safety-first approach is critical. The last thing you want is to give away more than you can comfortably afford, only to find yourself short on income later in retirement. Start by working with your advisor to model your future income and expenses, including healthcare costs, travel, and emergencies. Many retirees find that keeping a core nest egg, enough to cover their needs for the next 20 to 30 years, gives them peace of mind. Let's say you determine that $5 million will comfortably provide for your lifestyle, including a buffer for unexpected expenses. If your estate is $12 million, that means you could potentially gift or transfer up to $7 million now, locking in the higher exemption. Remember, for married couples, you can each use your exemption, so together you could transfer up to $14.0 million to $14.5 million after 2026, but up to $27.98 million if you act before the law changes. The sooner you finalize these numbers, the more options you'll have. Step 4. Choose the right vehicles: outright gifts, irrevocable trusts, or both. Once you know how much you can afford to transfer, work with your attorney to choose the best vehicles for your situation. Outright gifts are the simplest. Just transfer cash or securities directly to your children or other beneficiaries. But for most retirees, irrevocable trusts provide more control, protection, and flexibility. Depending on your goals, you might use a spousal lifetime access trust, SLAT, to provide income to your spouse, a grantor retained annuity trust, GRAT, to transfer future appreciation, or an irrevocable life insurance trust, ILET, to cover estate taxes with tax-free insurance proceeds. For example, if you have $3 million in appreciated stock, you could place it in a gratuity, allowing the future growth to pass to your heirs with little or no estate tax. Or, if you want to ensure your spouse is cared for, you might fund a $5 million slat, which pays income to your spouse during their lifetime, then passes the remainder to your children. Each trust type has its own rules, benefits, and timelines, so it's essential to work with an experienced attorney who understands the nuances. Step 5. Complete transfers and document everything, well before the deadline. The final step is to execute your plan, transferring assets and finalizing trust documents well in advance of December 31st, 2025. I recommend completing all transfers by October 2025 at the latest to allow time for any unforeseen issues. Make sure all paperwork is properly signed, assets are retitled as needed, and your financial institutions and custodians are notified. Keep thorough records of all gifts and transfers, including valuations and appraisals. The IRS may require documentation years later, and having everything in order will make the process much smoother for your heirs. Let me pause and recap what we've covered so far. First, you'll calculate your total estate and project future growth. Second, you'll meet with your estate planning team and set a firm deadline. Third, you'll determine how much you can safely gift or transfer. Fourth, you'll choose the most effective vehicles, outright gifts, trusts, or a combination. And finally, you'll execute and document everything well before the 2026 deadline. Throughout this process, it's normal to have concerns. Many retirees worry about losing control of assets, making mistakes, or triggering unintended tax consequences. That's why I always emphasize working with a qualified team and taking a conservative approach. The most successful retirees I work with review their plans every year and adjust as needed, especially when laws or family circumstances change. This is educational content, not personalized financial advice. Please consult with your financial advisor and estate planning attorney to tailor these steps to your specific needs. No strategy can guarantee a particular result, but historically, acting early and following a disciplined process has helped many families save millions in taxes and preserve their legacy. But before you take action, you need to avoid these critical mistakes, errors that can cost your family dearly and undo all your careful planning. In my decades of experience, I've seen even the most well-intentioned retirees fall into these traps, often because they didn't know what to watch for or failed to get the right advice. Before you move forward, avoid this costly mistake, because the next section reveals the expensive pitfalls that could derail your entire plan, and how to spot them before it's too late. Part 4. Costly Mistakes. How even smart retirees lose millions to estate tax pitfalls. Let's pause for a moment and reflect on what we've covered so far. You now know the urgency of the 2026 estate tax changes, the core strategies that can shield your legacy, and the practical steps to implement them. But here's something I've seen over and over in my 30-plus years helping affluent retirees. Even the most careful, well-advised families can fall into expensive traps that quietly sabotage their plans. These mistakes are rarely talked about in glossy brochures or quick online articles, but they can cost your family millions, and often you won't even realize the damage until it's too late. So let's shine a light on the most common and expensive pitfalls I've witnessed and how you can spot the warning signs before they threaten your legacy. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor and estate planning attorney to address your specific circumstances. Mistake number 1. Waiting too long, missing the window for large gifts and trusts. This is, without a doubt, the single most common and devastating error I see. Many retirees, even those with substantial estates, put off estate planning until the last minute. They tell themselves, "I'll do it next year," or "Let's see if Congress changes the law." But the reality is, the process of making large gifts or setting up sophisticated trusts isn't as simple as signing a form at the bank. It can take months to gather valuations, draft documents, complete legal reviews, and transfer assets. If you wait until the final quarter of 2025, you may find that your attorney and financial team are overwhelmed with last-minute requests from other clients, or that there simply isn't enough time to finish everything by the December 31st deadline. Here's the financial impact. If you have a $15 million estate and miss the chance to use the current $13.99 million exemption, you'll only have about $7.0 million to $7.25 million exempt after 2026. That means $8.2 million could be taxed at up to 40%, resulting in a potential $3.28 million tax bill, money that could have stayed in your family. The warning sign here is procrastination. If you haven't already started working with your planning team, now is the time. Every month you delay reduces your options and increases your risk. Mistake number 2, underestimating your estate's value, forgetting hidden or growing assets. Another frequent pitfall is underestimating the true size of your estate. In my experience, many retirees focus on their bank accounts and primary residence, but forget to include life insurance, death benefits, retirement accounts, valuable collections, or the full value of business interests. Even more commonly, they fail to account for future appreciation. For example, if your real estate portfolio or investments grow by 5% annually over the next 2 years, a $12 million estate can easily become $13.2 million or more by 2026, pushing you over the new exemption and into taxable territory. Let me give you a real-world example. I once worked with a couple who believed their estate was safely under the threshold, but when we factored in their life insurance and the rising value of their vacation home, their estate was actually $2 million higher than they thought. Had they not acted, their children would have faced an unexpected $800,000 tax bill. The warning sign here is incomplete or outdated valuations. If you haven't had your assets appraised or reviewed in the last 12 months, you could be at risk. Mistake number 3, using the wrong type of trust or failing to fund it properly. Setting up a trust is not a set-it-and-forget-it solution. I've seen too many retirees spend thousands on legal fees to draft a sophisticated trust, only to discover years later that it was never properly funded. If you set up a spousal lifetime access trust, SLAT, or a grantor retained annuity trust, GRIT, you must actually transfer the assets, stocks, real estate, or cash, into the trust's name. Failing to complete this step means the assets remain part of your taxable estate, and the trust is essentially useless for tax purposes. The financial cost can be enormous. Imagine you set up a $5 million trust, but forget to retitle your brokerage account or real estate. When you pass away, those assets are still in your name and subject to estate tax, potentially costing your heirs $2 million or more. The warning sign is paperwork left unfinished or assets not properly retitled. Always double-check with your attorney and financial institutions that every transfer has been completed and documented. Mistake number 4, overlooking state estate and inheritance taxes. Federal estate tax isn't the only risk. Many states, including New York, Massachusetts, Oregon, and New Jersey, have their own estate or inheritance taxes, some starting as low as $1 million. I've seen families focus exclusively on the federal exemption, only to be blindsided by a state tax bill that wipes out a large portion of their legacy. For example, New York's estate tax can reach 16% on estates over $6.94 million, and there is no portability for married couples. If your estate is $10 million and you live in one of these states, your heirs could face a state tax bill of $480,000 to $1.2 million, even if you avoid federal tax. The warning sign here is ignoring your state's rules or assuming federal law is all that matters. If you have homes or assets in multiple states, the risk is even higher. Work with your advisors to review both federal and state laws and consider relocating assets or changing residency if it makes sense for your situation. Let me recap these expensive pitfalls: waiting too long and missing the gifting window, underestimating your estate's value, failing to properly fund or title trusts, and overlooking state-level taxes. In my decades of experience, these mistakes are responsible for the vast majority of surprise tax bills that devastate families, and they're almost always preventable with careful, early planning. This is educational content, not personalized financial advice. Please consult your qualified advisors to ensure your plan is tailored to your needs and fully compliant with current law. No strategy can guarantee results, but historically, avoiding these traps has preserved millions for families across generations. Once you avoid these traps, you can access advanced strategies that most people never learn. The next level of estate planning isn't just about avoiding mistakes. It's about optimizing every dollar, using sophisticated tools and timing to maximize your family's benefit and minimize taxes. That's where the real power lies, and that's exactly what we'll explore in the next section. That's just the beginning. Here's where it gets really powerful. Part 5. Advanced Strategies: Maximizing Your Estate's Protection and Tax Efficiency. Now that you're aware of the common pitfalls and how to avoid them, let's move into the realm where true legacy building happens: advanced strategies and optimization. This is where, in my 30-plus years of helping affluent retirees, I've seen the most dramatic results. Families preserving not just millions in wealth, but also the values and opportunities they want to pass down for generations. These techniques go beyond the basics, leveraging the current law, advanced trust structures, and tax-savvy moves to ensure your estate is not just protected, but optimized. Again, I want to remind you that this is educational content, not personalized financial advice. Every family situation is unique, and it's essential to consult with your qualified financial advisor and estate planning attorney before taking action. No strategy can guarantee a specific outcome, but historically, these advanced moves have created remarkable advantages for those who plan ahead. Let's take a closer look at 3 of the most effective advanced strategies for high net worth retirees facing the 2026 estate tax changes. The use of spousal lifetime access trusts, SLATs, leveraging grantor retained annuity trusts, GRATs, and optimizing with charitable lead trusts, CLTs. Strategy: 1. Spousal lifetime access trusts, SLATs, flexibility and protection for couples. A spousal lifetime access trust, or SLAT, is a powerful tool that allows you to use your current high exemption while still providing for your spouse. Here's how it works. You create an irrevocable trust for the benefit of your spouse and potentially other beneficiaries like your children. You transfer assets, let's say $6 million, into the trust now using your 2025 exemption. The assets and all future appreciation are removed from your taxable estate. Meanwhile, your spouse can receive distributions from the trust during their lifetime, providing a safety net if you need additional income down the road. The key advantage here is flexibility. Many retirees worry about giving up access to their assets, but with a SLAT, your spouse retains access, and you both benefit from the higher exemption before it disappears. If you're a married couple with a $15 million estate, you could each set up a SLAT for the other, effectively doubling your tax-protected transfers. But timing is critical. Both trusts must be carefully structured to avoid the IRS's reciprocal trust doctrine, which could unwind the benefits if not done properly. Tax implications are significant. By using a SLAT, you could shield $12 million or more from federal estate tax, potentially saving your heirs over $4 million. And if you live in a state with its own estate tax, the savings can be even greater. Industry insiders know this is one of the most popular tools among wealthy families right now, but it requires expert legal drafting and coordination between spouses. Strategy 2. Grantor Retained Annuity Trusts, GRATS. Transferring growth out of your estate. If you have assets, such as stocks, business interests, or real estate, that are likely to appreciate significantly in the next few years, a Grantor Retained Annuity Trust, or GRATE, can be a game changer. Here's how it works. You transfer assets into the GRAT for a set term, usually 2 to 5 years. During that time, you receive annual annuity payments from the trust, essentially getting your original value back. At the end of the term, any appreciation above a modest IRS interest rate passes to your heirs, free of additional gift or estate tax. Let's use a concrete example. Suppose you transfer $5 million in stocks with high growth potential into a 2-year GRAT. If those stocks grow by 10% annually, at the end of the term, the appreciation, over $1 million, passes to your children without additional estate tax. The original $5 million is returned to you through annuity payments, so your risk is minimized. This is a conservative, proven approach that lets you freeze the value of appreciating assets for estate tax purposes while passing future growth to the next generation. GRATs are especially effective in volatile or rising markets and for assets with potential for rapid appreciation, such as private business shares or real estate in hot markets. The tax implications are substantial. You can transfer significant wealth with little or no gift tax, provided the trust is structured correctly and the assets outperform the IRS's Section 7520 rate. Strategy 3. Charitable Lead Trusts, CLTs, combining philanthropy with tax efficiency. For retirees who are charitably inclined, a Charitable Lead Trust, CLT, offers a sophisticated way to support your favorite causes while also reducing your taxable estate. Here's the strategy. You transfer assets, say $3 million, into a CLT, which pays annual income to a charity of your choice for a set number of years, often 10 to 20. At the end of the term, whatever remains in the trust passes to your heirs, typically with significant estate and gift tax savings. The benefits are twofold. First, you receive a charitable deduction for the present value of the income stream paid to charity, immediately reducing your taxable estate. Second, if the assets in the trust grow faster than the IRS's assumed rate, the excess passes to your heirs with little or no additional tax. For example, if your $3 million trust pays $150,000 per year to charity for 15 years, and the investments grow at 7% annually, your heirs could receive over $2 million at the end of the term, while you've supported causes you care about and reduced your estate tax exposure. This is a safety-first, values-driven approach that many of the wealthiest retirees use to create a lasting philanthropic legacy while still providing for their family. The tax implications can be substantial, especially when combined with other gifting strategies, but the rules are complex and require expert planning. Tax implications and integration. Each of these advanced techniques, SLATs, GRATs, and CLTs, offers unique advantages and can be tailored to your specific goals. The real power comes from integrating them into a comprehensive estate plan, coordinated with your other assets, retirement accounts, and income needs. For example, you might use a SLAT to provide for your spouse, a GRAT to transfer business growth, and a CLT to support charity and reduce taxes, all while preserving enough liquid assets to cover your own retirement and healthcare expenses. Industry insiders know that the key to success is timing and execution. These strategies take time to set up, require careful legal and tax coordination, and must be completed well before the December 31st, 2025 deadline to use the current exemption. If you wait too long, you may miss out on the benefits entirely. Let me repeat this important point. The sooner you implement these advanced strategies, the more options you'll have and the greater your potential tax savings. Every month you delay could cost your family hundreds of thousands or even millions of dollars. The most successful retirees I work with always review their plans annually and adjust as laws and family needs change. This is educational content, not personalized financial advice. Please consult your qualified advisors to ensure these advanced moves are right for your situation. No strategy can guarantee a specific result, but historically, those who act early and integrate advanced techniques have achieved remarkable outcomes for their families and communities. The key to success is getting your timing exactly right, knowing when and how to take each step so you maximize your exemption, minimize taxes, and avoid last-minute surprises. In the next section, I'll lay out a clear implementation timeline and sequence so you know exactly what to do first, second, and third, along with the critical deadlines you can't afford to miss. But timing is crucial. Here's exactly when to act to protect your legacy. Part 6, your estate planning timeline, step-by-step sequence to beat the 2026 deadline. Now that you've seen the advanced strategies that can help maximize your estate's protection, it's time to get specific about timing and sequence. In my 30-plus years of working with affluent retirees, I can tell you this: even the best strategy can unravel if the timing is off. The most successful families I've advised didn't just have great plans. They executed them at the right moment, with every step carefully coordinated. The coming change in estate tax law is not just about what you do, but when you do it. That's why I want to walk you through a clear, actionable timeline spanning the next 30, 60, and 90 days, and then looking further out, so you know exactly how to stay ahead of the curve. Let's begin by setting the stage. As of today, you have less than 2 years before the federal estate tax exemption is scheduled to be cut nearly in half. That means every month, every quarter, and every year counts. The administrative process for implementing trusts, transferring assets, and conducting legal reviews is not something you want to rush. In fact, I've seen families lose out on millions in tax savings simply because they waited until the last minute and couldn't get everything finalized in time. So, let's break down your action plan. First 30 days, assessment and team assembly. The very first step within the next 30 days is to take a full inventory of your estate. This means listing every asset: real estate, retirement accounts, investment portfolios, business interests, life insurance, and any valuable collections. Update the values based on current appraisals or statements. Don't rely on old numbers. Asset values can change quickly, and you need an accurate snapshot. Once you have your numbers, schedule an initial meeting with your estate planning attorney and financial advisor. If you don't already have a team with deep experience in high net worth estate planning, now is the time to find one. Ask specifically about their experience with advanced gifting and trust strategies for estates above $10 million. In my own work with retirees, I've seen that the best outcomes come from a team approach: legal, tax, and financial professionals working together from the start. During this first month, set your target completion date for your estate plan updates. I recommend aiming for no later than October 1st, 2025, to ensure ample time for any unforeseen delays. Next 60 days, strategy design and document drafting. Between day 31 and day 90, you'll move from assessment to design and action. This is when you work closely with your team to decide exactly which strategies to implement. Will you use a spousal lifetime access trust, SLAT, a grantor retained annuity trust, GRAT, outright gifts, or a combination? Your advisors will help you weigh the pros and cons based on your needs, family structure, and risk tolerance. Once you've decided, your attorney will begin drafting the necessary documents. This can include trust agreements, power of attorney updates, advance healthcare directives, and any amendments to your will. Your tax advisor will model the potential outcomes, projecting how much you can safely transfer without jeopardizing your own retirement security. Remember, the goal is to maximize the use of your current exemption, $13.99 million per person, or $27.98 million for couples, before it drops in 2026. During this phase, you'll also need to gather supporting documents, deeds, account statements, business valuations, and life insurance policies. The process can be time-consuming, especially if you have assets in multiple states or complex business interests. In my experience, this is where many plans stall, so stay proactive and keep your advisors on a clear timeline. Next 90 days, execution and asset transfers. By the end of the 90-day window, you should be ready to execute your plan. This means signing trust documents, formally transferring assets into the new trusts, updating beneficiary designations, and confirming all legal and tax filings are in order. If you are making large gifts, your advisors will help you file the necessary IRS Form 709 gift tax return for the year in which the gifts are made. It's critical to follow through on every step. I've seen retirees lose out on millions in tax savings because assets weren't properly retitled or trust paperwork was left unsigned. Double-check with your attorney and financial institutions that every transfer is complete and documented. If you're using more advanced structures like a GRAT or SLAT, confirm that the trust is funded and all related accounts have been updated. Key deadlines and dates to remember. December 31st, 2025. This is the absolute last day to make use of the current high exemption. Any gifts or trust funding must be fully completed, with all paperwork signed and assets transferred by this date. Waiting until the end of 2025 is risky. Institutions and advisors will be overwhelmed, and you may not be able to get everything done in time. October 1st, 2025. I recommend this as your target completion date. This gives you a 3-month buffer for any last-minute issues, such as delayed appraisals, legal reviews, or family decision-making. Annual reviews. After your plan is in place, schedule annual reviews with your team. Laws can change, family circumstances evolve, and asset values fluctuate. The most successful retirees I work with revisit their estate plan every year, especially as major legislative changes approach. What to do: first, second, and third. First, inventory your estate, update valuations, and assemble your team within 30 days. Second, design your strategy, draft documents, and gather supporting paperwork over the next 60 days. Third, execute transfers, sign documents, and confirm all steps are complete within 90 days, well before the October 2025 target. Important note on state deadlines. If you own property or have residency in states with their own estate or inheritance taxes, check those deadlines and thresholds as well. Some states require additional filings or have different exemption amounts. Your advisors should coordinate state and federal planning to avoid surprises. Recap and key takeaway. Let me pause and recap. Over the next 30 days, assess your estate and assemble your team. In the following 60 days, design your strategy and draft all documents. By the end of 90 days, execute your plan and complete all transfers. Ideally, months before the end of 2025 rush. The sooner you start, the more options you'll have, and the less likely you'll be caught by last-minute complications. This is educational content, not personalized financial advice. Always consult a qualified financial advisor and estate planning attorney for your specific situation. No timeline can guarantee a specific result, but historically, early and disciplined action has helped retirees preserve millions for their families. Even if you follow this perfectly, you might encounter these common roadblocks, unexpected challenges that can stall or complicate your plan. In my decades of experience, knowing how to troubleshoot these issues is just as important as the plan itself. That's what we'll tackle next. But there's one critical issue that could derail everything. Let's look at the most common roadblocks and how to overcome them. Part 7. Troubleshooting and Problem Solving. Overcoming roadblocks on the path to estate security. So far, we've mapped out a clear step-by-step timeline for shielding your estate before the 2026 tax law changes. But as anyone with real-world experience knows, even the best-laid plans can hit unexpected snags. In my 30-plus years of guiding affluent retirees through complex transitions, I've seen families face challenges that, if left unaddressed, can delay or even derail their estate strategies. The good news? With the right preparation and a problem-solving mindset, nearly every obstacle can be overcome. This is educational content, not personalized financial advice. Please consult with your qualified financial advisor and estate attorney for your unique situation. No plan is immune to complications, but historically, those who anticipate and address roadblocks early have enjoyed far greater peace of mind and better results. Let's walk through some of the most common implementation challenges, and I'll show you proven solutions as well as what-if scenarios you may encounter along the way. Challenge 1. Family disagreements and decision paralysis. One of the most frequent and emotionally charged roadblocks is family conflict. Maybe one child wants the family business while another prefers a cash inheritance. Perhaps a spouse is hesitant to move significant assets out of the estate, fearing a loss of control or security. Or in some cases, blended families in second marriages add layers of complexity that make consensus difficult. In my experience, the most successful retirees address these issues head-on, not by avoiding tough conversations, but by bringing everyone to the table early. Schedule a family meeting, ideally with a neutral third-party facilitator, such as your estate attorney or a trusted advisor. Lay out your intentions, explain the reasoning behind your decisions, and invite questions. Transparency is key. If you're using trusts, clarify who will serve as trustee and how distributions will be managed. The more you communicate, the less likely you'll face challenges or resentment down the road. What if a family member still objects or threatens to contest your plan? In that case, your attorney can include a no-contest clause in your will or trust, which discourages legal challenges by reducing or eliminating inheritances for those who contest. While not foolproof, this strategy has historically minimized costly disputes and preserved family harmony. Challenge 2. Asset liquidity and funding trusts. Another common challenge is asset liquidity, having enough cash or marketable assets to fund trusts or make large gifts. Many affluent retirees have wealth concentrated in real estate, closely held businesses, or illiquid investments. When it's time to transfer assets, you may discover that selling or dividing them is more complicated than expected. The solution starts with early planning. Work with your financial advisor to identify which assets are best suited for transfer. For illiquid holdings, consider funding a trust with a fractional interest or using a business valuation to determine fair market value. If you own a business, you might explore a phased gifting strategy, transferring shares over several years to maximize tax efficiency while retaining some control. For real estate, you could use a qualified personal residence trust, QPRT, to remove the property from your estate while continuing to live there for a set number of years. What if the market shifts and your asset values drop before the transfer is complete? In that case, work with your team to revisit your gifting plan. You may be able to swap assets in and out of trusts or adjust the timing of transfers to take advantage of lower valuations, which can actually reduce gift tax exposure. The most successful retirees I work with maintain flexibility and review their plan annually to adapt to changing market conditions. Challenge 3. Legal and administrative delays. Even with a great plan, legal and administrative delays can threaten your timeline. Attorneys, appraisers, and financial institutions are often overwhelmed in the months leading up to major tax law changes. I've seen clients wait weeks for appraisals or struggle to get assets retitled before critical deadlines. If you wait until late 2025, you may find yourself at the back of a very long line. The best way to avoid this is by starting early. Ideally, completing your major transfers by October 1st, 2025. Set clear expectations with your advisors. Ask for a written timeline, regular status updates, and confirmation when each step is complete. If you encounter delays, consider temporarily funding trusts with cash or liquid securities, then swapping in other assets later. Many trusts allow for asset substitution, but the rules are complex, so always check with your attorney first. What if an advisor or institution simply can't meet your timeline? In my experience, it's better to pivot to a backup plan, such as making outright gifts or using simpler trust structures, than to risk missing the exemption window entirely. Remember, partial action is better than none. Even if you can't execute your entire plan, transferring some assets can still shield millions from future taxes. Challenge 4. Changing laws and IRS guidance. Tax laws are always evolving, and the details of the 2026 exemption change are no exception. Congress could act to extend the current exemption, adjust rates, or introduce new rules. The IRS may issue updated guidance on how gifts and trusts are treated. Uncertainty can lead to analysis paralysis, where retirees delay action in hopes of more clarity. The most successful retirees act based on current law, not speculation. History shows that waiting for perfect certainty usually leads to missed opportunities. If the law changes in your favor, you can always adjust your plan later, but you can't retroactively take advantage of a window once it's closed. In my 3 decades of experience, those who act decisively with the best information available are the ones who preserve the most for their families. What if Congress does extend the higher exemption? In that case, your gifts and trusts are still effective, and you've gained valuable peace of mind. If the law changes in a way that impacts your plan, your annual reviews with your advisor will give you the chance to make timely adjustments. Recap and reassurance. Let's pause and recap. We've addressed 4 major roadblocks: family disagreements, liquidity challenges, legal delays, and legislative uncertainty. For each, the solution is early action, clear communication, and flexibility. In my 30-plus years helping retirees, I've found that those who anticipate challenges and build in contingency plans almost always achieve their goals, even when the unexpected happens. This is educational content, not personalized financial advice. Please consult your qualified advisors for recommendations tailored to your needs. There are no guarantees in tax or estate planning, but historically, those who troubleshoot and adapt enjoy far greater security and satisfaction. Once you master this foundation, you're ready for the next level, fine-tuning your plan for maximum impact and making strategic adjustments as your needs and the law evolve. The final piece of the puzzle is optimization. How to keep your plan working for you and your heirs for years to come. That's just the beginning. Here's where it gets really powerful as we explore how to optimize and future-proof your estate plan. Part 8. Next Level Actions and Optimization. Future-proofing your estate for generations. Congratulations on making it this far. If you've followed along through each step, you now understand the urgency of the 2026 estate tax changes, the core strategies to shield your legacy, the practical steps and advanced techniques for implementation, and the common roadblocks that can arise. But as I've seen in my 30-plus years working with affluent retirees, true success in estate planning isn't just about executing a plan once. It's about ongoing optimization, scaling your strategies as your wealth and family situation evolve, and building in the flexibility to adapt to whatever the future brings. This is educational content, not personalized financial advice. Please consult with your qualified financial advisor and estate attorney for guidance tailored to your situation. No plan can guarantee a specific outcome, but historically, those who commit to long-term optimization leave the greatest impact for their families and communities. Let's explore how you can take your estate planning to the next level, maximize your results, and ensure your legacy stands the test of time. Advanced optimization. Number 1. Layering trust strategies for generational wealth. Many of the most successful retirees I've worked with use a layered approach to trusts, not just relying on a single structure, but combining several to address different needs and time frames. For example, you might use a spousal lifetime access trust, SLAT, to provide ongoing support for your spouse, a grantor-retained annuity trust, GRAT, to move appreciating assets out of your estate, and a dynasty trust to benefit children, grandchildren, and even great-grandchildren for decades to come. A dynasty trust, in particular, can be a game-changer for families with substantial wealth. By allocating part of your exemption to a trust that skips multiple generations, you can create a pool of assets that grows outside of your taxable estate and is protected from creditors, divorce, and even future estate taxes. For example, if you fund a dynasty trust with $5 million before 2026 and that trust grows at 6% per year, it could provide tens of millions in benefits to your descendants over the next century. Industry insiders know that this is a favorite tool among America's wealthiest families for a reason. It creates lasting impact and resilience. Advanced optimization number 2. Ongoing tax-efficient withdrawal and gifting strategies. Estate planning doesn't end once the trusts are funded and the gifts are made. The most effective plans include ongoing tax-efficient withdrawal and gifting strategies. For example, you might coordinate annual exclusion gifts, up to $19,000 per recipient, per year as of 2025, to children and grandchildren, further reducing your taxable estate over time. If you have a large IRA or 401k, consider Roth conversions to move assets into a tax-free environment for your heirs, especially if you expect tax rates to rise. Another powerful technique is asset location, strategically placing different types of assets in taxable, tax-deferred, or tax-free accounts to minimize your overall tax burden. For instance, holding growth stocks in a dynasty trust while keeping bonds or income-generating assets in your personal accounts can optimize both income and estate tax efficiency. In my experience, retirees who revisit these decisions annually with their advisor often save hundreds of thousands in unnecessary taxes over the long run. Advanced optimization. Number 3. Flexible planning for changing laws and family needs. One of the most important lessons I've learned from decades of estate planning is that change is inevitable. Tax laws will shift, markets will fluctuate, and your family's needs will evolve. The best estate plans are built with flexibility in mind. This might mean including decanting provisions in your trusts, allowing a trustee to move assets into a new trust if the law changes. Or it could mean naming a trust protector, a neutral third party who can make adjustments to the trust's terms if circumstances change. Another forward-thinking move is to periodically review your healthcare directives, powers of attorney, and beneficiary designations. Life events, marriages, divorces, births, deaths can all impact your plan. The most successful retirees I work with schedule an annual estate checkup with their team to ensure their wishes are current and their plan is still optimized for both tax and family goals. Scaling strategies as your wealth grows. If your estate continues to grow through investments, business interests, or real estate appreciation, you'll want to scale your strategies accordingly. This could mean funding additional trusts, increasing annual gifts, or exploring advanced charitable vehicles like private foundations or donor-advised funds. These tools not only reduce estate tax exposure, but also allow you to involve your family in philanthropy, teaching financial stewardship and values across generations. For example, a private foundation gives you and your heirs a platform to support causes you care about, while also providing ongoing tax deductions and asset protection. Donor-advised funds offer a simpler, more flexible option for charitable giving, with lower administrative burdens. In my experience, families who embrace philanthropy as part of their estate plan create stronger bonds and a deeper sense of purpose. Long-term considerations. protecting against scams and elder abuse. As you age, protecting your estate from external threats is just as important as optimizing for taxes. Unfortunately, seniors with significant assets are frequent targets for scams and financial abuse. The most effective protection is a combination of strong legal safeguards, such as carefully selected trustees and durable powers of attorney, and regular communication with trusted family members and advisors. Consider implementing checks and balances by appointing co-trustees or requiring dual signatures for large transactions. Stay informed about common scam tactics and educate your family members. In my 30-plus years, I've seen that families who maintain open lines of communication and involve multiple trusted parties in financial decisions are far less likely to fall victim to fraud. Future-proofing your legacy. The ultimate goal of all this planning is not just to minimize taxes, but to future-proof your legacy. That means creating a structure that can adapt to changing laws, support your family's evolving needs, and reflect your values for generations to come. With the right combination of layered trusts, ongoing tax optimization, flexible planning, and vigilant protection, you can ensure that your wealth serves as a force for good long after you're gone. Let me recap what we've covered. Advanced trust layering, ongoing gifting and tax strategies, flexible provisions for changing laws, scalable charitable tools, and robust safeguards against fraud. These are the hallmarks of truly optimized estate plans, and they're what separate families who merely avoid taxes from those who build enduring legacies. This is educational content, not personalized financial advice. Please consult your qualified advisors for recommendations tailored to your situation. No plan is one size fits all, but historically, those who commit to ongoing optimization achieve the best outcomes for themselves and their loved ones. Now, as you look ahead, remember, the window for these strategies is closing fast. The next step is to take decisive action. Review your plan, meet with your advisors, and make the moves that will secure your legacy for decades to come. What I'm about to share will surprise even experienced investors because the final piece of the puzzle is how to maintain peace of mind and family harmony, no matter what the future brings. Over the past hour, we've covered a tremendous amount of ground together, delving deep into the coming estate tax changes and how they will impact Americans with estates of $12 million or more. Let's take a moment to acknowledge the time and focus you've invested. The knowledge you've gained today could save your family millions of dollars, protect your legacy, and spare your loved ones from unnecessary financial and emotional stress. This isn't just entertainment. This is high-value financial education representing decades of experience distilled into practical, actionable guidance for retirees like you. To recap, we began by identifying the looming problem. The federal estate tax exemption is set to drop by nearly half in 2026, putting substantial estates at risk of 40% or higher taxation on amounts above the new threshold. We explored the core solution foundation, strategic gifting, and advanced trust planning, showing why these strategies work especially well for retirees who have clarity about their needs and goals. We broke down practical implementation steps, including how to calculate your estate, assemble your team, and execute transfers before the window closes. We revealed the most expensive mistakes to avoid, from waiting too long to underestimating your estate's true value. We examined advanced optimization techniques, such as layering trusts, ongoing gifting, and scaling for future growth. And we mapped out a timeline and troubleshooting guide so you can act with confidence even if you hit roadblocks. Let me emphasize this important point. What separates financially secure retirees from those who struggle is usually knowledge and implementation. In my decades of helping retirees optimize their finances, I've seen these strategies work for thousands of families across different market cycles. The wealthy retirees I advised didn't get there by accident. They followed proven systems, acted early, and sought the right guidance. You've just equipped yourself with the same playbook. Now that you understand each piece, here's how they work together. When you combine proactive gifting, advanced trust structures, and ongoing optimization, you create a comprehensive estate shield that compounds in effectiveness. For example, a retiree who acts now, transferring $10 million into trusts before 2026, can permanently remove that amount from their taxable estate, saving their heirs $4 million or more in federal taxes alone. Add in state tax savings, ongoing annual gifts, and asset growth inside a dynasty trust, and the lifetime benefit multiplies. This is why wealthy retirees often outperform those with even larger starting estates. It's not just about what you have, but how you structure and protect it. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances, regardless of what Congress or the markets do next. Sleep better tonight, knowing your estate plan isn't just a document on a shelf, but a living, evolving strategy designed to protect your family for generations. Your experience and wisdom, combined with these strategies, create a powerful advantage. So, what should you do next? Here are the 4 action steps you can take within the next 30 days to secure your legacy. Step 1. Assessment phase. First week. Start by gathering your 3 essential documents: your most recent net worth statement, copies of your current estate plan, wills, trusts, power of attorney, and updated account statements for all significant assets. Calculate your current estate value, including real estate, retirement accounts, life insurance, and business interests. Use a simple spreadsheet or net worth calculator if needed. Identify your biggest opportunity area, whether it's gifting, trust funding, or updating outdated documents. Step 2. Planning phase, second week. Create a personalized timeline based on your age, health, and family goals. Research the specific options we've discussed, such as SLA, TS, GRATS, and dynasty trusts, and see which fit your situation. Document your current strategy and compare it to what you've learned. Are you maximizing your exemption? Do your trusts allow for flexibility if laws change? Are your beneficiary designations up to date? Step 3. Professional consultation, third week. Schedule a meeting with a qualified estate planning attorney and a financial advisor who specializes in high net worth strategies. Bring these specific questions. How can I lock in the current estate tax exemption before 2026? Which trust structures are best for my goals? How do state taxes affect my plan? Verify that your advisors understand advanced gifting and trust strategies and that they coordinate with each other. Don't be afraid to seek a second opinion if you're not confident in their answers. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change first, such as funding an irrevocable trust or making an initial large gift. Set up the systems and accounts needed for your new strategy, including trust bank accounts, brokerage transfers, and updated legal documents. Begin tracking your progress with simple metrics: total assets transferred, exemption used, and projected tax savings. Remember, most successful retirees implement these changes gradually over 6 to 12 months, not all at once. Remember, every financial strategy carries some level of risk. The goal isn't perfection, it's optimization based on your unique situation. Don't let perfectionism prevent you from making small improvements that can have a huge impact over time. These aren't get-rich-quick schemes. They're proven, long-term strategies that protect what you've built. Most retirees' biggest regret is waiting too long to act. The cost of inaction often exceeds the cost of making informed, imperfect decisions. You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake. Measure your success not just by the size of your estate, but by your increased confidence and peace of mind. You're now part of a community of informed retirees who refuse to settle for average planning. The journey to financial optimization is ongoing. Markets change, laws evolve, and your family's needs will shift over time. Continue your education by staying informed about retirement planning developments. Share your success stories and learn from others who are implementing these strategies. The more you engage, the more you'll benefit from the collective wisdom of retirees who have walked this path before you. If this video helped clarify your retirement and estate planning strategy, please give it a thumbs up so more families can benefit. Share your biggest takeaway in the comments. Was there a strategy or insight that surprised you? Which step will you implement first? Subscribe for more in-depth retirement guidance that could save your family thousands or even millions over the coming years. Most importantly, take action on what you've learned. Your future self and your loved ones will thank you. Remember, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and the tax implications we discussed may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified advisor can help you customize these strategies for your specific situation, ensure you're maximizing benefits while staying compliant, and help with the legal aspects we discussed. Imagine the legacy you'll leave, one of wisdom, security, and generosity. Your children and grandchildren will benefit from the smart decisions you make today. Maintain your independence and dignity by taking control of your financial destiny. You've worked too hard to settle for average. Now is the time to optimize, protect, and build a future that honors your life's work. The sooner you act, the more options you'll have, and the greater your family's benefit will be. Don't let this rare opportunity slip away. Take the next step today and let your legacy endure for generations. Thank you for joining me on this journey to secure your estate before 2026. I look forward to hearing your stories and helping you navigate the path to lasting financial peace of mind.